Thanks for joining us. We have seen a little bit of softness for stocks so far this morning, and September is notoriously tricky for investors. Let's get some more on the outlook as we head into the fall season. Ed Clissold is Chief U.S. Strategist at Ned Davis Research. Ed, it's great to see you. Obviously, a lot of headwinds that we are talking about, a cooling economy or signs of potentially cooling economy. How are you approaching the story right now? What's top of mind for you? What are you seeing in the trends?
Well, I think one of the things we need to be careful of as we move forward is what's going on with the Federal Reserve, where most people think that there may be one more hike later this year. We think there's a risk for maybe, especially heading into next year, being a second hike. And so now we're at the point where cash is a very reasonable alternative to stocks, where you're getting well over 5%. And so whereas last decade, the buzz, the catchphrase was TINA, there is no alternative, and now it's TERRA, there are reasonable alternatives. So for example, the S&P 500 earnings yield, that's the inverse of the PE ratio, is about 1.3 percentage points below cash. That is, cash is cheaper than stocks. That's not how it normally is. And so a lot of investors are saying, well, if I can get 5.5% from cash, why would I want to be in stocks? And so we just have to recognize that whenever there's a problem in the stock market, whereas last decade you may have to shrug your shoulders and say it's still the best game in town, now there's some alternatives of some pretty risk-free returns available to investors.
And is there any historical? I mean, you're great with the charts and the trends, and I wonder, when you have those kind of yield dynamics, is there any historical evidence that leans into where the money flows ultimately?
Well, yeah, ultimately the money does kind of end up in cash for the time being. Now, these are not great timing tools if you're trying to make a tactical trade between now and the end of the year. These kind of valuation metrics, may or may not work. It's going to tell you what could happen over the long run. And normally, eventually you get a cyclical bear market in stocks. The one exception was in the mid-90s when we had a similar dynamic, because earnings growth boomed. We had about 50% earnings growth cumulative over a 3-year period. So basically we grew out of the problem. I don't think even the most bullish strategists are expecting that kind of earnings growth. So eventually, maybe it's a 2024 problem, not necessarily a 2023 problem. This dynamic fixes itself through stocks getting cheaper, i.e. stock prices going down in a bear market.
All right. Sector-wise, any trends you're watching right now?
Yeah, so on a tactical basis, we have a cyclical tilt because the U.S. economy is doing better. So we're overweight technologies, that's a cyclical growth sector, but we're also overweight energy and industrials. Those are more cyclical value sectors tied to the stronger economy. And so that's how we're positioned now. I'd say, as we get late this year or into next year, we may take off some of those cyclical bets if the economy does look like it's going to cool. But for now, I think it's a cyclical over defensive call.
Okay. Ultimately, you talked a little bit about what the Fed may do. What does history tell us about getting closer to the end of rate hiking cycles, but when you're in this sort of period where we're just not quite sure where we go from here?
Yeah, I think it's a more of a back and forth. So whereas the first half of this year, the rally was really based on the idea that we're not going into recession, or every data point that suggested we weren't going into recession was viewed as good news. Now it's more of a back and forth where, good news is good news unless the economic data is too good, and then it's bad news because it means the Fed's going to hike more, which is kind of what we're getting this morning. So I think it's more of a choppy environment. We think we can still end the year higher than we are now for U.S. stocks. But it's definitely going to be a little bit of a choppier environment until we get a better handle on when the end of the Fed tightening cycle is going to be here.
And then is there anything, what's unique right now outside of the central bank actions is the fact that you have this debate over whether we're at a transformational moment in technology. All this is playing out in a year where all of a sudden AI becomes part of the market narrative. You have a few companies that have leaned into that have outsized influence in the market. Does that change the dynamics as well to a certain degree, Ed?
I think it does, because this can be a sentiment-driven market for the time being, because there aren't a lot of great ways to play AI other than some of these mega cap stocks. So other than liking them for their traditional businesses, people may pile into them for that reason. Now, then these stocks get expensive. For example, if you take the 8 largest stocks in the S&P 500, they account for about 28% of the market cap. It's about 18% of total earnings. And that 10% gap, John, is about the biggest on record. So it doesn't mean those stocks can't continue to rally and outperform, but their earnings had better come through because they've already rallied in anticipation of those earnings. So if there's any kind of hiccup there, then that valuation gap, could be a problem. But as long as they're the only game in town and people are excited about AI, it can be a momentum boost for cap weighted indices like the S&P 500.
Hey, great to